Hey everybody, it's your friend Jason Pound here answering the top questions asked by home buyers in today's real estate market. And the burning question we're tackling today is, how can I avoid private mortgage insurance? Well, real quickly, put down more than 20%, avoid FHA loans, and number 3, if you're going to do a VA loan, have a veteran disability. That's how you avoid it. As usual, let me over-explain. The whole reason private mortgage insurance exists is not to protect you, but to protect the lender. The lender is in the business of lending money. They are not in the business of renting out properties and flipping properties for profit. Rather, they want to lend you the money and make money off of your interest payments. However, they have realized that people who do not have larger down payments are more likely to allow their homes to be foreclosed on. So how can these lenders feel warm and fuzzy and be given the assurance that everything is going to be okay? Well, that is through an insurance program called private mortgage insurance that protects your lender if you have to be foreclosed on, and it is covered by an insurance policy that you paid for. That's basically what private mortgage insurance. Now, there is a misnomer here. I have been using the term PMI, which is for a conventional loan. If you look at an FHA loan, it's called MIP. If you look at a VA loan, it is called a funding fee. At the bottom of all this, these are insurance programs to provide assurance to lenders that will make them feel warm and fuzzy so that they will lend you the money you need to buy your house. So how do we avoid these? Well, if you're going to do a conventional loan, which is a loan product that is designed for people that have lots of cash but not so good credit, or they have lots of cash and they have good credit. Either way, it's for people who want to avoid paying assurance premiums. If you put down more than 20%, you do not have to purchase that insurance for the benefit of your lender. If you have to put down less than 20%, it is temporary. It goes away once your loan falls down to 78% of the original purchase price. Once it hits 80% of the purchase price, you can manually call them and ask them to take it off. But by law, it has to go away at 78%. The cost for that is approximately 1.5% of your original purchase price each year. The second type of assurance program is through the FHA loans. FHA loans were designed for people who have good credit, but they don't have a lot of cash. As a result, every single loan that is done through the FHA program is going to have some sort of insurance attached to it. And it is going to be attached permanently. And there's two parts. You have an upfront cost of 1.75% of the purchase price. So to keep the math easy, if you did a $100,000 purchase, your upfront cost is going to be $1,750 plus a monthly insurance premium on top of your standard mortgage payment to give the FHA the assurance that you will not need to be foreclosed on. And if they do foreclose on you, they will not take as big a loss. The final program is with the Veterans Administration. They charge an upfront cost of 2.15% if you're going to do their zero down payment program. The more money you put down, the smaller the assurance premium is needed. Or if you have a veteran's disability, they will also waive that for you. And it is only one time an upfront and not a continuation after the fact. So, my name's Jason with Jericho Pound Realty Group. To avoid private mortgage insurance, have more than 20% down. Don't do an FHA loan. And if you're going to do a VA loan, have a veteran disability. My name's Jason Pound with Jericho Pound Realty Group. At Keller Williams Mullinex in Norman, we service the entire Oklahoma City metro area with hyper-local expertise in South Oklahoma City, more in Norman. If we can ever be of service, don't hesitate to reach out. In the meantime, peace out. Have a great life.